What is a DEX? Well, a DEX is the crypto solution simply for trading tokens, and lots of them exist. Mostly they're variations of Uniswap, which is definitely the most well known DEX. It actually launched without a token at first, and it worked perfectly fine. But most DEXs are actually terrible businesses. And when they have a token, you could see this poor sustainability, poor value capture takes its toll. Token price, usually goes up in the very beginning and then tanks for a long period of time, never to recover. There is one DEX in Cosmos. It's called Astrovault. It stands out as a much better business model with a token that's much, much more than a reward token. I'm going to bring in Eric. He's the co-founder. He's going to walk us through the basics so people that are buying the token or are using the DEX can understand a little bit about how it works. All right, Eric, thanks for coming on again. We're going to talk about Astrovault. We're going to talk about the token, the AXV Astrovault token, how it's actually used to kind of manage liquidity that's earned and owned by the Astrovault DEX. Thanks so much for coming on to teach us all about this.
Joe, thank you for having me back, brother.
All right. And just so people that are watching know, I'm a holder of the token. I use the DEX all the time. I participated in the initial token sale. So kind of just going to use Eric here to pump our bags together, and I'll just nitpick about how Astrovault works because I forgot the first 5 times you taught me, but I haven't made a really specific video about the basics like this. So hopefully people get a lot out of it, and then they understand what they're buying. They understand why what they're using is a lot different from other DEXs. Sound good?
Sounds great.
All right. So let's talk about Astrovault first as a business. It's a DEX, it's an AMM, but it has revenue, and you guys talk about the revenue all the time. What's one source of revenue that Astrovault has?
One source is we're the first to monetize liquidity. Basically, the bulk of the liquidity on Astrovault is actually staked on the layer ones in Cosmos, and we're earning the staking rewards as protocol owned liquidity. So we take the staking rewards being given out to all the tokens securing the chain, we're securing the chain, and we get more and more liquidity that the AXV token holders own.
Okay, so on most dexes, let's talk about osmosis, right? I buy Atom, I buy Osmo, I put them together, I drop them into a liquidity pool, and I hope for the best as a liquidity provider, right? I don't want too much impermanent loss. I want to collect some fees, I guess, and also I'm hopefully getting rewards from the dex itself. If I do this on Astrovault, let's say I buy Atom and I buy Arch. Don't even know if that's a pool, but let's start there. Astrovault takes the Atom tokens, sends them back to the home chain, stakes them with Astrovault's own validator, I'm guessing,
Um,
on the hub.
Not on
Oh,
Atom. We're not in the active set there, but
okay,
when we're in the active set, we stake it to our own validators. When we're not, we delegate to somebody who's a friend.
okay, perfect. So you're staking the Atom tokens. If I'm supplying liquidity, there's a derivative in place of Atom in the pool. The Atom is earning whatever the staking rewards are, and then periodically those rewards are getting deposited back into the pool.
Yes. Yeah.
Okay. All right. So I own my liquidity position, but now there's additional tokens in the pool from the staking yield of Atom and Arch, right? So you have sources from 2 different sources because there's 2 different layer 1 tokens in there that are being staked, at least partially being staked. Who does that belong to? Like, let's say the months go by, eventually a good portion of that pool is gonna be from the staking yield. Who owns that?
That is owned by the DAO, which is the collective AXV token holders.
Okay. So again, I want to make this video about the token as well. Let's start with the token as a governance token. It's a DAO token. Let's start there. It's not only a DAO token, but that token is needed to control, make decisions on that liquidity that the DEX earns, right? It's going to be growing. Eventually there's going to be way more protocol earned liquidity than there will be liquidity deposited by individuals, probably, right?
It's likely. Our goal is that that's never the case because as we showcase how we're growing, hopefully we continue to get more and more external liquidity in. But yeah, for sure, our protocol owned liquidity will constantly be growing.
Yeah. Okay. All right. So this is totally different. I've never seen any protocol turn around and stake those tokens. And in fact, now after reading the white paper, I read the white paper about, I don't know, not a year ago, but a long time ago. I remember reading that part of the white paper about, wow, those tokens are staked. That means any protocol that doesn't stake tokens that are deposited in a smart contract that counts as their TVL, it's getting diluted by inflation minute by minute, right?
Yep.
So yeah, so that's one thing that struck me. I was like, all right, at least they're not getting diluted. And then I always wondered what happens to that. So again, so one source of revenue is taking advantage of the emissions around the Cosmos ecosystem, which generally has, you know, pretty much double digit, low to mid double digit yields for virtually every single layer one token. If they are LP'd on Astrovault, the protocol managed by the token holders is getting that yield constantly, depending on the um, the amount that's actually deposited, right?
Yes, sir.
Okay, and is that considered the protocol own liquidity becomes like almost like a treasury that's deployed throughout the DEX?
Yeah, Patrick, the CEO of Jackal Labs, basically called Astrovault a VC liquid fund, LARPing as a DEX. In essence, yeah, it's owned by the AXV DAO. We can do whatever we want with it. Our governance isn't just what we can do with our own token; it's what we can do with other tokens. But where it really gets interesting is we can also vote on the other protocols with not just the tokens we own, but also all of the liquidity on the DEX.
Right. Okay. Let's talk about that in a minute. Actually, that might trigger some people. Let's start slow. Let's talk about why other DEX tokens, why other DEXs have shitty models before we trigger people on governance. So, all right. What I learned early about DEXs is they basically have to overpay to attract LPers like me. I don't want an LP. I don't want impermanent loss unless I'm getting a big yield. And then I make a judgment call. Okay, it's worth the risk. I'm getting, you know, this percent in swap fees, and I'm getting 58% in this reward. And then maybe I'll get external rewards, whatever it is. The DEXs cannot afford to pay that at all, not even in the beginning, but they do it anyway. It's almost like they're desperate from day one. Would you agree with that?
Yeah, and I really liked in your intro you were talking about, like Uniswap started without a token, and the way they were doing
Yeah.
that was they like give all the swap fees to the liquidity providers. But what happens when the swap fees aren't enough and the APRs not enough to get the liquidity in? They're desperate to have enough liquidity to function so that in theory they could make money. Like if I want to run a small business, say I want to open, a restaurant, it's going to cost me like maybe 100, 200 grand to get started. And then once it's operating, then maybe I can make money from it. The issue with these models is they're issuing out this upfront capital that they're printing these tokens to try to get in the liquidity so they can function. But then when they function, they don't make any money from it. So it's like, what if you spend this 200K upfront to open up a restaurant and then give out meals for free? That's not gonna work for you.
Right. So in the beginning, I was LPing on osmosis, like triple digit, quadruple digit yields, right? And I'm pairing two tokens. I drop them on the DEX. Osmosis, the DEX, is paying me super high emissions from their own token. I'm getting it, and I'm either depositing it back into the liquidity pool to kind of compound my position. I'm swapping it for something else, which is putting sell pressure on the Osmo token. I've looked at this on Cardano, on Ethereum, throughout Cosmos. It definitely doesn't work, but usually what happens is in the beginning, there's always a spike in price because the protocol's new. People are interested. The token gets marketed, and there's very low float usually. It doesn't take long for things to go south. The super high emissions paid out; those tokens are always out there forever. They're even when the cycle turns, in other words, there's so many tokens now in circulation. There's almost no chance for any of these DEX tokens to return to all-time highs. They need really specific conditions for it to happen. I don't know if Uniswap's ever got back to its all-time high, but I would imagine if that's the most successful DEX probably, and that token can't even get to its all-time high. What makes anyone think any other DEX token will ever do that? I don't see one. I try to avoid them like the plague, to be honest.
That's yeah, me as well. That's literally why we built Astrovault, because we agree with the ethos. We can't actually have P2P cash and everything that the decentralized ethos of the decentralized ethos of crypto is going for unless we have dexes, and none of them make any sense. None of these tokens are going to succeed long term, and if they fail, the liquidity won't stay, and if the liquidity doesn't stay, they don't work. And so you can just keep on opening a new dex every 2 or 3 years like we're seeing, and like, oh, now this
Yeah.
one has high APR, and then the token goes to zero, and that just completely recycles. Or you can actually build something that's sustainable, that lasts, that earns enough revenue, that yes, it pays out emissions, but has a balanced budget. Shocking, right?
All right. So balanced budget. Let's start there. Astrovault is not paying out crazy rewards for LPers, right? Even though
Depending
there is a treasury, it could be paid out from there. Maybe some of it is, but you guys have a net gain versus just hemorrhaging your own token out there into the ecosystem to hopefully get liquidity long enough to turn profitable.
so
How
the
Yeah,
last several weeks we have been operating profitably, yes.
okay. How do you get liquidity on the DEX without paying out all these rewards? That's like a secret that no one's figured out.
Yeah, I mean, we do have the rewards. There are lots of opportunities to get 30-40% APR on these pools. It's just most of them, we're earning more than that on the pool, which is incredible because we have the liquidity yield, like the staking rewards from these assets, and we also get 100% of the trade fees, back to the DAO. They either go to protocol-owned liquidity or they buy back and burn our token, and so like our argument was never that like, oh, you can LP for 40% on osmosis, but you can LP for 100% on Astrovault. It was long term, you can't LP for 40% on osmosis. There's no way you can afford that. Like when that goes to zero, you'll still be able to LP for 20 to 30% on Astrovault. I think we've shown that really well. They passed the proposal saying that they're no longer going to give incentives to Cosmos based pools. The APRs on osmosis are incredibly low, lower than the staking APR for almost all of the Cosmos assets, which means now it's only teams that are liquidity providing, because users can have no impermanent loss and just stake instead, which is a lot less risky. So now there's just way less liquidity in the ecosystem because your everyday person isn't providing liquidity. We're saying since we have the baseline of the staking rewards and we also get the trading fees, we can usually offer yield that's higher than just what staking rewards are while keeping your money liquid. And we can do that at a rate that's still profitable to us. Like
And for a longer period of time.
we're paying
Right.
out higher than what the trading fees are, but lower than what we're earning from the global pool.
Right. So that's all right. So you're earning in two places here so far:
Mhm.
the trading fees, and then the staking rewards that are used to supplement the trading fees. Is that fair to say?
Yeah.
And if I'm LPing, I'm getting a little bit of both, or the trading fees specifically used to offset the inflation of the token, which is mediocre inflation, I would say, right?
Yeah.
For by Cosmos standards.
Yeah. If you're liquidity providing, you're getting neither. You're only getting the AXV emissions and the DAO. So you're getting added to to the DAO by getting more AXV, but
Okay.
now the AXV DAO is earning both the trading fees and the liquidity rewards. We've talked like been asked a lot, like, oh, well, can't you guys just do this without a token? Like if somebody is LPing Atom and Arch, like you brought up, can't they just get the Atom rewards and the Arch rewards? And the answer is yes. We could give those staking rewards right back and operate without a token. The issue is now you can't have a stable pool because the USDT, USDC pool or something like that isn't earning staking rewards. The trade fees are incredibly low. That liquidity is never going to come in. Now, the whole of the DEX operates a lot better if that pool has liquidity. Like that makes sense for us to operate as a loss leader for our business. I come from a casino background.
Mhm.
Casinos lose money on their restaurants, their valet, their hotels. Every part of the business loses money except for table games and slots. But
Right.
having those other businesses operate at a loss makes them make so much more money from where their real money makers are. And so we want to kind of operate like that. And if we kind of conglomerate all the rewards and give out incentives, some pools at a loss, about a one-fourth of our pools are operating at a loss, most of them AXV pools, but like if it's got wrapped Bitcoin or if it's got USDC, it's more of a high value liquidity to us, we can operate those pools at a loss, pay a little bit too much for it, and have the DEX work a lot better while we make profits on things like the Atom Arch pool.
How about those trading fees? There's always a limit to where you could nickel and dime users, right? Could you take trading fees off certain pools and still be okay? Because I would imagine the majority of what those pools earn is coming from the staking rewards anyway, at least on some pools. Could you at least temporarily eliminate fees, maybe to just encourage more use or to make it more attractive for aggregators to kind of tap certain pools that you have?
Yes, we could actually operate just fine completely without trading fees if we want to. And we talked about this a lot as a team. Some of our fancy types of pools need some kind of trading fees. That's neither here nor there. But for the most part, we could get rid of trading fees in main pools and be just fine. But kind of what we realize is like our model is far, far ahead of anything else I've seen in DeFi, really, and we don't have to be as generous and as giving as we possibly can be because now it does make it harder to be profitable. We might actually have to lower APRs to do something like that. Um, we don't have to be as generous as we can be. We just kind of have to beat the competition. So we do have the lowest in the industry trading fees, and we give part of our emissions back to traders, which nobody else is doing
Mhm.
through Gravitate. But if we ever feel like it, yeah, we if you guys vote as a DAO, like, hey, let's just get rid of trading fees in these pools, or let's go a month without trading fees, we totally can.
All right. So as far as APRs go, you can compete with dexes that have been around for a while and already exhausted their ability to pay super high incentives. But like you said, there are new dexes popping up all the time because the only time they really work for everyone is that small window in the beginning, right? The token's overvalued. The team can sell to kind of pay themselves. The LPers can farm, right? So they're getting a benefit for all the risks they're taking, and then the people get to trade in these new pools. It works for a short window in a bull market. Maybe it's like what 6 months, 5 months, something like that. In a bear market, it's like one day probably, right? So how will you compete with dexes that come after you now
Mhm.
that could copy your model, just triple the APRs on you, and then just be in and out in like a half of a cycle.
Yeah, the idea of tripling the APR to me shows higher expense. We're trying to do what we can. Like, if anything, we might be erring on the side of conservatism, but we'd love your guys' feedback. In that we are operating profitably. Some people are like, oh, crank up the APRs if you're running profitably. You should be running at a loss. Maybe there's merit to it. We haven't actually seen that much more liquidity come in from the higher APR pools as much as we'd potentially expect. We are still reasonably unknown at this time. We have no VC backing. We aren't part of the super well connected insiders. We built this on the outside looking in. Nobody was begging us to build this. We were just frustrated with what existed and want real business to have an opportunity to integrate into DeFi in a way that will last. And so we just built it ourselves. Um, it We can't compete with every DEX on every pool. Some people have already complained. They're like, "Oh, like, well, I can get 30% APR on my stables on this other DEX, and I can only get 6% on your DEX." I'm like, "Okay, be a rational actor. Go farm that other DEX, and as you do, you're going to sell their token, and it's going to go to zero, and that same cycle is going to keep going." If we are going to continue to last, if we are going to continue to grow, we have to operate within our means, and that involves not competing on every single asset all of the time. But we can compete on a lot of the assets most of the time because, frankly, we operate far more profitably, far better than these dexes that are paying more for different assets. So, yes, people will try to copy it. There's a reason we're closed source. We're not. We're trying to like profit off of our really novel model that nobody really has been able to copy at this point, especially our new concentrated liquidity pools, as concentrated as it could possibly be. But it takes balance, and if it comes the case where there's 10 other dexes and each of them is out competing us in 1/10 of our assets and we're not competitive in anything, it's possible that it might be worth it for us to consolidate and just like, hey, we're going to focus on these 5 assets, pay higher APR for those, and just make sure that any trades that go through those tokens through any aggregators route through us. Like, it might be better to be a bit more niche. I'm not convinced of that yet.
Got it. So, and you could be flexible because you're not a layer one. You don't have to worry about all kinds of proposals to distract people. People that are involved in this app, they hold the AXV token. They're only going to worry about proposals to change parameters on this one specific app. So you could probably be a lot more flexible than some of the others that are out there that might be layer one dexes, like like Osmosis, like Crescent was, or whatever the case might be. All right. So you talked about balance, you talked about expenses, we talked about revenue. Can you kind of paint the picture for a newcomer here? How do you balance these things? I
Uh,
think people when they use these apps, they just assume that everything's going to work out. Oh, they must be doing well. I see pictures of their devs eating caviar over here on a cruise ship over here. The app must be doing just wonderfully. I bet any project that launches a token from scratch and gives it away is doing horrendous after 6 months, 10 months, 12 months. Talk about balancing budget, revenue, expenses, what you guys are looking to do that's different than, let's say, an Osmosis, a Uniswap, or any other DEX, any other DeFi protocol really that has a token.
Yeah, I know it seems blasphemous to come up and say like, "Hey, Uniswap makes no revenue," because if you Google it, it'll give you a number, but that number is how much revenue the LPs make on the DEX. It's not actually what the protocol is making. So
Right.
protocol revenue is a little bit different. And we were blasphemous at the top of the last bull market, going through saying, "Hey, Osmosis is making zero in revenue with their multi-billion-dollar valuation. If they had our model, they'd be making $464 million a year." It's true. That's absolutely how it would have worked. Now they've adopted they've adapted. Their DEX is making some protocol revenue now. Their chain is making some protocol revenue now. They're growing. Still, if they had our model, they'd be making 10x what they currently are. So we're we're biased towards our model. Obviously, remind me where we're going with the question.
Balancing budgets.
Okay,
How do you guys do it? How, and I guess, what's the competitive edge in this when you lose out on that hype train in the beginning of a launch, right? So
yeah,
balancing budgets, expenses, revenues, is it going to work really? Because it's unheard of, and no one cares. No one
yeah.
cares about it. But I would like to just park my token somewhere and not worry about it, and not have to check in the middle of the night if everything goes to shit.
Yeah, the biggest concern right now is the idea that no one cares, and for us to kind of even highlight that this is a thing, that we are the only DEX with a balanced budget in all of like in all of Web3, it does mean we have to go and expose that nobody else does, that nobody else can. But it the way it works is we have a fancy econ paper, we've got some fancy formulas, and we tinker with it a little bit all the time. But basically, we figure out how much money we're making from each pool each week. We weight them based on how important that liquidity is. So like having $1,000 worth of USDC is more important than having $1,000 worth of X asset that nobody's ever heard of before with a 200% stake in inflation. The USDC will stay long term. Like Bitcoin
Right.
has pretty good Lindy numbers. So we weight the pools in accordance with how important the liquidity is to us, and then we give out our rewards basically in proportion. So it will automatically set it up where like AXV pools are operated at a loss. That means we pay them a little bit more than they're worth to us, because in our opinion, that's giving more value to our token holders. Those are people liquidity
Mhm.
providing our token. People who are LPing wrap Bitcoin and USDC might be getting paid a little bit more than technically they should be. But now if you're in Cosmos, Arch, or a lot of these L1 to L1 chains, we can still offer APRs higher than what their staking rewards would be. We can offer them APRs higher than they could get anywhere else in Cosmos or in any other DEX, while we're securing their chain, while we're helping them with marketing and biz dev, because we're literally invested in them. But meanwhile, we
Right.
can earn more from that pool than we're spending in rewards.
Your treasury, your protocol only, I should say our treasury, right? I'm a big token holder. It's diversified. So like you said, you do care about what happens to Jackal, Atom. There's wrapped Bitcoin and wrapped ETH, right? We have this treasury that's automatically diversified, whereas most DeFi protocols only have one token in their treasury, and it's the token that they made up in the beginning of when they wrote their white paper. Like, wait, put something in there about a token, and then we'll worry about the token's value, like when it's time for us to dump, right? So, could you take the treasury and say, let's pay out Bitcoin to these five pools. Let's pay out ETH to these five pools, and let's not pay out our token for 90 days and see what happens. Or let's pay a combination of tokens out to this particular pool because we want to attract liquidity over there. Is that something that's accounted for in the parameters that people can vote on? Do you see a value to that, or is that just like creating a gimmick that will only have short term effects?
Is it a gimmick that's primarily short-term effects? Probably. Is that worth it? Maybe. That's totally up to the community to decide. Yes, we can just straight cash out. We can just, hey, give all token holders, disperse all the arch. Or it could be like, hey, let's take $200,000 of other tokens and let's use it all to buy AXV and send the price up, 10,000x. Like we can do that. Now that's always going to be short-sighted. My argument
Yeah,
is if we do that, at the end of that, people are going to sell it back down. It's going to be chasing a pump. Everyone's going to ape in so that like basically we're going to front run ourselves, and at the end of it we just have less liquidity that we own. So I'm
right,
hoping that we err to the side of longevity, of trying to build for 10, 20, 100 years rather than trying to pump the token so I can exit in the next 2 months. I've argued with several community members who are trying to push that, like, I'll put everything to buybacks and burns, and I'm like, take all the POL, buy the token up. I'm like, yeah, of course you're saying that, because then you're going to sell it and you're going to be happy and you're going to be in other projects. I'm still going to be here in 2 years. I'm still going to be building this. So I care way more about the long term. But we definitely need some kind of balance. So if that kind of gimmick, as you call it, maybe is worth it, then great. As we like maybe collect airdrops with our liquidity from other things. If you guys want us to open up a farm and give it out to AXV stakers, we can. Or if you guys want us to put it in a pool, we can. Whatever the DAO decides is the best path forward.
speaking of airdrops, you bring up something important. All of our atom is staked to whichever validators. Is it spread out to a whole bunch of wallets so that we can maximize airdrops? It's probably
No.
not a concern in the beginning, right? um, can we vote to farm airdrops since we're staking all these tokens, right? That's like the benefit of staking an atom or something like that. Even Arch, right? Arch is kind of new. I would imagine there'll be some Archway airdrops at some point. Um, that's something that we could vote on to say let's divide our atom holdings to 15 wallets, and then hopefully if there's a whale cap on the next biggest airdrop, we maximize. That is a problem though with DAOs staking tokens. They get capped and then they can't really disperse to the DAO members fairly.
Yeah. It it's tough. My answer is going to be probably not. I don't think it would really be safe for us to do that. The reason it's difficult for us to claim airdrops is because all of these derivatives basically run through smart contracts hosted from Archway. Like it's difficult to go through a
Got
claiming
it.
process if it has to like so you have to like click some button through your wallet. Like nobody can control this wallet unilaterally to click a button. There is no UI we can access things through. So realistically, we probably won't be able to claim a whole lot of airdrops. And if we were to spread this out into actual like regular wallets, then it wouldn't be safe to count that towards actual liquidity. So if we did that, then basically our X derivatives would be under collateralized, which again we could do. But as soon as we take that step, at that point it's not secure. At that point, we're doing fractionalized banking, or we're Terra
Right.
Luna and we're only partially collateralized. And we can find that balance of like, oh well, we're 70% collateralized, and since the DAO's not going to liquidate, we're fine. I'm nervous because that is by definition a slippery slope.
All right. And last question. You mentioned no VCs. I would imagine you would shop this protocol, this model, right? I mean, VCs should be interested in this. Um, obviously, your users who were there from the beginning before there was a token got in on this outbid token sale at a very favorable price, like what, like a $2 million market cap, something like that, right? You
Lower,
said
yeah.
the DEX is already profitable. VCs are usually looking for a deal. This is probably still a deal. Have you had any talks that you could mention, or you could just give a thumbs up, blink twice, whatever? Um, anyone knocking down the door, or are you shopping, or is this not a focus right now for the Astrovault team?
Yeah. We've been talking to some funds for a long time, like since pre-Terra crash. We actually had at one point like $1.2 million in soft commits at like $150 million valuation back in the day, but because like, hey, Osmosis will be making 464 million a year. They're making zero, and nobody really understood that. But they're like, it sounds cool. I'll throw money at it. Back when money was fierce, of course, it was all from Terra people. Terra crashed. It all went away. Glad we didn't accept any UST before it
Yeah.
crashed, as we were actively trying to get people to get out. But after that point, basically deals stopped as a whole. Nobody was really able to raise. And what frustrates me a lot about like from the outside looking in with the VC deal flow, they are complete penny stock gamblers. They only care about a 10,000x. And so they're only interested in infrastructure science fair project plays. They don't care about a sustainable business that's going to give them consistent returns. That's going to, I've been told plenty of times like, oh, this is an easy, completely safe 10 to 100x. We don't do 10 to 100x. We only take a shot at 10,000x. I'm like, that sounds stupid to me, but hey, they're in business. So we'll see. We've had
Yep.
we've had good conversations. We definitely have a lot of people's interest. I think if the Archway ecosystem starts picking up a lot, that will help. Still to this date, zero Archway apps have received any funding from VCs. Like, that is a risk in this ecosystem. If it is going to blossom and take off, that needs a change. And if it is going to change,
Yep.
it's obviously going to start with Astrovault. So hoping that we see that pick up a lot. We'll see. We're having conversations.
Yeah, I mean, I'm of the mindset that VCs, at least they're professional risk takers. You don't have all the risk placed on your own community like another chain in Cosmos that we won't name. Um, Juno, I would like to see actual investment worthy protocols being built on Archway. You guys will benefit, I guess, as like just as the DEX on that chain that's going to have to host tokens and be used for liquidity. All right, so I own AXV. What can I do with it right now?
Right now, you can stake it to earn AXV, which, I mean, pretty much everyone can stake their token to earn more of their own token
And
until they
those
run
are
out
the
of their own
those are
token.
the farms on the app, right? It says farms.
Yep.
Okay.
But additionally, from staking AXV to earn more AXV, you can stake AXV to earn Arch at a higher APR than you can stake Arch to earn Arch. And if you stake Arch to earn Arch, you have to wait 21 days to take your funds out. If you stake AXV to earn Arch, you can pull it out whenever you want. You can stake AXV to earn Jackal. You could stake AXV to earn Plank. And we can turn on the farms of any of these other assets we're earning whenever we want to. A lot of people have asked us to turn on the Atom farm. We've held off on it, but maybe we'll open that pretty soon. And you can stake AXV to earn Atom and to vote on Atom governance props, because we don't just vote with the amount that we own, which as a DAO we own over $50,000 worth of Atom. We don't just vote with $50,000 worth of Atom. We vote with all of the staked Atom in the entire platform that anybody owns.
Right.
We give all the governance power to our token holders. So yeah, you don't just vote on Astrovault. You don't just vote on what we can do with other people, like the money that we've earned from other ecosystems. You can go vote on how those protocols are going to operate, what they're going to do on their spending props. You can go vote on the Atom Accelerator DAO stuff. We're kind of a weird governance aggregator. Realistically, our token has more utility than anything else. But as we build multi-chain, our token is going to function pretty similarly to USD3 or USDC from Noble, where they have CCTP. Basically, what that means is our token will burn and mint onto different chains, and you'll
Okay.
be able to trade across multiple chains seamlessly. No, oh, I have to bridge. Oh, I'm going to use Astrovault on this chain. No, you'll use all of the chains that we're on all at the same time. And that's because of how we've set up AXV to function. So we just function differently than other tokens. So that itself is quite a bit of utility that we really needed our token for.
Got it. All right. Well, I hope this was a good primer for people that are doing some research before they dive into the decks. Obviously, I want my bags pumped, but I would like people to actually know what they're buying before they get into it. Um, Next time, I would like to talk about all the different pools that you guys offer. Maybe some DeFi degen whale, reckless whales, I call them. We'll be interested to hear all the different opportunities you guys have with the different pool types. And yeah, as usual, this was really great. I appreciate you coming on.
Joe, thank you so much for having me, brother.
All right. All right. Not too cynical, right? That was like right there. That was good.
Yeah.
All right. Did I get your name this time? I know there's A's in there and
Nope.
shit. Fuck, man. I'm so bad. One N?
ANEN.
I knew there's two A's. Why can't you just have like a nice, easy Italian last name? One N or two?
Um, 1N. Yeah. So yeah, ANEN.
All right. This part's
There we
definitely
go.
going in this part's definitely going in the video. All right. I spelled Astrovault right. And we'll talk about Archway, but I put Cosmos in there for the broader YouTube um, people.